To this new video. This time we will be discussing the two of the best Canadian index ETFs out there. And I know there is a lot of investors who are asking themselves which one they should choose between the XIU or XIC. So XIU and XIC are XIU is the iShares S&P TSX 60 index, and the XIC is the iShares Core S&P TSX capped composite index. So the purpose of this video is to compare these two. Basically, they are both index ETF and they are both meant to track the Canadian market. However, the coverage, the exposure is quite different. So in this video, we will be talking in detail about these two funds. And if you are wondering which one to choose, hopefully this video will help you figure out the one that suits best your interest and your objective. So what's an index ETF? An index ETF is the most common type of ETF, and it's the first one ever ETF created was an index ETF. And the purpose of an index ETF is basically, as the same implies, is to track an index. So by just looking at the name of the ETF, you would know already what it's tracking. So if it's saying TSX S&P index, that means that it's tracking the Toronto Stock Exchange, the TSX. And the purpose of the manager at that point is really what we call here passive management. So the index is known. We know already what constitute the index. So the manager is simply replicating what's in the index. So they are either acquiring the same stocks that are parts of the index or using derivatives to have the same performance of the index. Passive strategy has proven over time that it's the best option for investors. Why? Because of two reasons. First of all, the cost is very low cost because you don't have to pay the manager a lot of money, since we're talking here about replicating an index. So there is no guessing, no research, no analysis, no whole team assessing risk on all that. So this reduces drastically the cost for running an ETF that it's an index ETF. So it's beneficial for investors because at the end of the day, the bank or the issuer will charge only really minimal fees for this type of ETFs. And also the other objective is diversification. An index, by like, you can't have an index with two or three stocks. When we say an index, it's usually a large number of stocks. So you're acquiring something that has a large number of stocks, so it's already diversified. And also its simplicity, it's super simple to understand. If you're trying to explain to someone, uh, describe to me your ETF, like they will just remember that it's an index and it's tracking whatever is in on the Toronto Stock Exchange. So it's easy for investors to understand in comparison to, let's say, an active ETF where the manager is following um, a certain objective and it's too complex for investors to understand. Index ETF brings simplicity, diversification, and low cost. So that's an index ETF, and the manager does not overthink. They will just replicate the index. Does an index ETF pay dividends? Of course, yes, it does. If the portfolio, within the portfolio, if the stocks are paying dividends, then you will receive also dividends, unless it's stated in the objective of the index ETF to reinvest those dividends. But most will just replicate the index, and if they get any dividends, it will be paid back to you. Uh, here we're talking about the index definition, and why we're doing this, because these two ETFs are tracking two different index. They are both have TSX here, but there is a difference here. The S&P TSX 60 is basically the 60 largest companies on the Toronto Stock Exchange. So instead of having the whole index, you will have only the 60 largest companies that are on the Toronto Stock Exchange. The S&P TSX capped composite index, that's different. It includes over 200 Canadian stocks, and basically it represents overall 95% of the Canadian equity market. So it's really much broader than the TSX S&P TSX 60. XIC is following this index. So when you invest in XIC, you're investing in over 200 Canadian stocks, and you have a portfolio that almost encompasses 95% of the Canadian equity market. There is obviously some conditions to be part of those 200 stocks. So there is the liquidity. They don't want to end up with stocks that are really like small cap and not liquid enough. So to simplify their work, they're focusing only on the largest 200 stocks that are out there. So by investing in XIC, you are uh, truly getting the picture of the Canadian Stock Exchange. The word capped here is means that they are putting a cap to make sure that no single stock weighs more than 10%. This allows for diversification, allows to have less, because as you know, the Canadian Stock Exchange has some large corporations that make up a good portion of the index. So here they're trying to say, let's put a cap so no single stock can exceed 10%. For XIU, it's tracking the S&P TSX 60. So you're investing in the 60 largest corporations. That's it. That's all. They're just replicating those six. They are acquiring those 60 largest stocks, and they are basically just they keep track of those 60 largest stocks, and they try to have the same representation as in the stock market. So here you will, by investing in XIU, you're owning indirectly 60 of the largest stocks on the TSX. And so it's really easy to understand. You're just holding large cap basically. Whereas for XIC, you're holding large cap and mid cap. So it allows also for diversification to own um, large and mid and small cap versus owning just large cap. So in terms of the asset under management and the management expense ratio, XIU has asset under management over 10 billion. What assets under management means is how much how much money is in the fund, which translates to how many investors own XIU. So you can see that XIU is really owned by a large number of investors with over 10 billion in assets. That means when you want to buy, sell, there is really high liquidity. The management expense ratio is the total expenses that the funds incur. So you have the operation and the management fee. The management fee is the salary of the manager and the employees, and operation is just the admin stuff and also the cost to do transactions on the TSX. So the MER is the total. So whenever you want to buy a fund, always check its MER and compare it to similar funds with similar objective to see if you're getting a good bargain. MER eats your profit, so you have to pay attention to it. So if it's a high MER, then they are deducting this from the performance of the fund, and over time it can obviously have an impact on your performance. So for XIU, it's 0.18%. And for XIC, it's only 0.06%. So in terms of MER, XIC is definitely better. In terms of assets under management, XIU has 10 billion, XIC 8 billion. I would say they are both liquid at that level. There's definitely both are liquid, but in absolute terms, XIU is more liquid. It has because it has more investors there and larger assets. So that's the comparison in terms of assets under management and management expense ratio. In terms of performance, as we could see, it's kind of similar because let's face it, like when you're tracking an index and the largest companies in that index usually decide the performance of the overall index. So that's why you would see the numbers are close. There is a better performance by XIU, which is the TSX 60. It has a better performance, but it's just slightly better. This is if you look just at the total return. However, whenever you want to evaluate performance, you have to link it to volatility. Volatility and performance go hand in hand. So you don't judge by just performance because you could have something that really high performance, but the volatility is super high, and the volatility is something that it's the risk aversion. So you could end up buying that stock that has really great return, but when it's volatile, you might sell it because you're just too afraid to stay in the market when it's collapsing or falling down. So it's something to keep in mind. You want the highest return with the lowest volatility possible. Okay. So I added a table here comparing the volatility, and it's measured by the beta, which is to simplify, it's like a standard deviation over the past 5 years. And the beta of one means that your stock that you're owning is as volatile as the market. If it's higher than one, it's more volatile than the market. If it's lower than one, it's less volatile than the market. So when you want to invest in a stock or an ETF, check its beta. If it's the beta is high, and you're fine with it, you say, I'm willing to have more volatility than the market, but you should demand more performance, more return, because you're taking too much risk. You should get a lot of rewards for it. So the beta is a good measure of volatility. And you can see here, XIU has a lower beta, so it's lower volatility and has a better performance. So it's definitely a good choice. The only issue with XIU is what we discussed with the MER. The management expense ratio is higher than XIC. Uh, that's uh, that's a minus for XIU, but overall the beta is better. The performance is slightly better, so I would personally prefer to own XIU. Why it's less volatile? It's normal because it's owning large caps. Large caps don't move as much as small cap or a mid cap, whereas XIC owns small and mid and large. So that's why it's a little bit more volatile, but it's still less as volatile as the market, approximately at 0.98. So it's almost one. So it's as volatile as the market. I added here the Morningstar rating, but keep in mind Morningstar rating they change every 3 months because they do their review and they check again. And so this thing like they are just valid for the quarter that you're checking. That's it. Like that keeps changing. So here I'm just summarizing here. XIU has the lowest volatility because it's holding large Canadian companies which tend to be more stable than the overall market. How to pick the best ETF, whether you're comparing XIU or anything else, you have to check the diversification. So we could see that, for example, XIC is more diversified than XIU because it has more stocks. However, in empirical studies and in finance, if you own more than 40 stocks, you're already diversified. If you are in a portfolio or an ETF that has more than 40 stocks, it's already diversified. So you're even if you own 1,000 stock or 60 owning 40 stocks versus owning 100 stocks, it's not a big difference in terms of diversification. That's from an empirical like studies, finance studies point of view. But if we just look at the numbers, XIC is more diversified than XIU because XIC owns 200 holdings, whereas XIU has only 60 stocks there. In terms of taxation, they are similar. They both distribute dividends, and that dividends coming from Canadian companies. So it should be treated in the same way. Of course, I'm not talking here about owning this in an RSP or TFSA, just in general. In terms of liquidity, XIU is more liquid than XIC, but I think both are very close because XIC has more than 8 billion of assets under management. XIU is not the winner in terms of management fees. It's much expensive. I personally am surprised by the 0.18%. I would expect an index ETF to be much lower than that. But as we saw in terms of performance, it still has value even if the management expense ratio is a bit higher. All these ETFs, index ETFs, can be purchased. Whereas if you're trading on Questrade, Wealthsimple, or any other big bank, you could acquire index ETFs. You have just to put the ticker XIU.TO or XIC.TO, and you will be able to acquire these index ETFs. In terms of portfolio management, they are absolutely great and absolutely essential for any portfolio because they bring diversification, and index ETFs overall have always had better performance over time than active ETFs or even active mutual funds. So index ETFs bring a lot of value, and this is why they are super, super popular since they were launched. So I would encourage you to consider including index ETFs in your portfolio because they bring that added diversification, and they are the best way to have a portion of your portfolio invested uh, uh, in something that you would know in the long term. In long term, Canadian index or the U.S. indexes like the S&P 500 or the Nasdaq 100, over time, all these indexes beat the managers who are supposedly active managers who are trying to beat those indexes. Usually, these indexes beat all the active index. And even like if you look at Warren Buffett, his advice to all investors is just to own an index ETFs of the S&P 500, like for US investors. So index in ETFs definitely are a plus in any portfolio, and you should consider them. And also they are safer, like if you are new to the stock market or you don't know how to pick stocks. So definitely an index ETF is a safer choice because right from the get-go you are diversified and you're owning overall a good portfolio of equity stocks. So that's it for my video. If you have any questions, please let me know in the comments, and if you like the content, please subscribe. Thank you.